If you have been following financial news lately, opened a retirement planning magazine, or even had a conversation with a financially aware friend, you have almost certainly heard the same advice being repeated everywhere. Roth conversions are being promoted as the ultimate retirement strategy. Financial commentators, online videos, and television programs present them as a near-perfect solution to outsmarting future taxes and securing your nest egg for life. They make it sound effortless and universally beneficial. But here is a reality that is not getting nearly enough attention. For a significant number of retirees and pre-retirees, converting a traditional IRA to a Roth IRA today could turn out to be one of the most costly and irreversible financial decisions of their retirement. That is exactly what this discussion is going to address clearly and directly. Over the next few minutes, we will walk through 6 real, practical reasons why leaving your money in a traditional IRA may be the smarter choice for your specific situation. We will examine the tax bracket traps, unexpected Medicare penalties, strict IRS rules that limit access to your own funds, the impact on your Social Security benefits, and a powerful charitable giving advantage that most people overlook entirely. Missing even one of these factors could result in thousands of dollars in unnecessary taxes and penalties over the course of your retirement. Let us go through them one by one. The first reason comes down to a very simple but fundamental trade-off. Are you going to pay taxes to the government today, or are you going to pay them later? To understand this properly, we need to look at how the real-world numbers work in 2026. Every year, the Internal Revenue Service updates its tax brackets and standard deductions. For 2026, if you are a married couple filing jointly, your standard deduction is $32,200. Now, suppose you and your spouse are still in your peak earning years. Your combined income places you squarely in the 24% federal tax bracket. Converting your traditional IRA to a Roth IRA under these circumstances is similar to purchasing a heavy winter coat in the middle of a blizzard. The price is at its absolute highest point. While you are still working and bringing in a solid income, your effective tax rate is likely the highest it will ever be during your lifetime. If you choose to convert money to a Roth IRA right now, you are voluntarily paying the Internal Revenue Service 24% of your retirement savings today. Now, consider what happens when you actually retire. Your regular paycheck ends, you begin living off Social Security benefits and modest withdrawals from savings. Your overall taxable income drops significantly. Because your income decreases in retirement, your tax bracket drops right along with it. You may fall from the 24% bracket down to the 12% bracket. The logical question then becomes this: why would you volunteer to pay 24% on those retirement dollars today when you could simply wait, leave the money alone inside the traditional IRA, and pay only 12% on those same dollars later? A common counterargument is that the national debt is climbing and tax rates are going to rise in the future. This concern is understandable and widely heard. But here is the important reality check. Even if the federal government does raise tax rates in the future, your personal income in retirement will still be lower. If Congress raises the lowest bracket from 12% to 15%, that 15% figure is still dramatically lower than the 24% you would be paying right now while employed. The fear of unknown future tax increases causes many people to make a mathematically poor decision today. For the vast majority of pre-retirees, the personal income reduction that comes with retirement will more than offset any potential rate increases the government may impose down the road. Patience in this situation usually pays dividends. This is the trap that tends to catch people most off guard when they actually sit down and work through the numbers. When you convert money from a traditional IRA to a Roth IRA, the Internal Revenue Service does not treat this as simply moving funds from one account to another. Instead, the IRS treats the entire converted amount as ordinary taxable income for that calendar year. If you convert $50,000 this year, the government adds that full $50,000 directly on top of your existing taxable income. It is treated exactly as if you earned an additional $50,000 salary from a second job. This creates a very real new tax bill that must be paid when you file your return. And this brings us to the critical rule that governs whether a Roth conversion makes financial sense at all. If you are going to convert, you must pay the resulting tax bill using cash from your regular, everyday bank or savings account. You should never pay that tax bill using money withdrawn from inside the retirement account itself. Here is a clear example of why this rule matters so much. Suppose you convert $100,000 into a Roth IRA, and this conversion triggers a $20,000 federal tax bill. If you do not have $20,000 in accessible cash outside of your retirement accounts, you might be tempted to simply pull that $20,000 directly from the IRA to pay the IRS. If you do that, only $80,000 actually lands inside your new Roth IRA. This is a compounding mistake. By pulling $20,000 out of your retirement account to pay the tax bill today, you permanently forfeit all of the tax-free compound growth that $20,000 could have generated over the next 10, 15, or 20 years. Once that money leaves the retirement account and goes to the federal government, it cannot grow for you anymore. Additionally, if you are under the age of 59 and 1/2 and you use IRA funds to pay those taxes, the IRS imposes an additional 10% early withdrawal penalty on top of the ordinary income tax. This creates a damaging chain reaction that completely eliminates any mathematical benefit of the conversion. The bottom line is straightforward. If you do not have a sufficient reserve of liquid cash outside of your retirement accounts ready to hand over to the IRS at tax time, a Roth conversion should not be on the table. It is never wise to shrink your own retirement nest egg in order to fund a tax payment today. This is what many financial professionals refer to as a stealth tax, and the government has assigned it a formal name, the Income-Related Monthly Adjustment Amount, or IRMAA. This is likely the most underestimated trap in all of retirement planning. The majority of people have no idea this rule exists until it is already too late to avoid it. To understand why IRMAA is so dangerous, we need to revisit how the government interprets a Roth conversion. As discussed earlier, when you convert a traditional IRA to a Roth IRA, your taxable income spikes artificially for that one calendar year. You might only be drawing $80,000 per year to cover your living expenses, but on paper, a large conversion makes it appear to the IRS as though you earned 2 or 3 times that amount. Here is where the problem emerges. Your Medicare premiums are not a fixed cost. They are directly tied to your income. But Medicare does not evaluate your current income. Instead, it applies a strict 2-year look-back period. To determine your 2026 Medicare premiums, the government examines the modified adjusted gross income you reported on your 2024 federal tax return. For 2026, the specific numbers are as follows. If you are a married couple filing jointly, the baseline income limit is $218,000. If your combined income remains at or below $218,000, you pay the standard monthly Medicare Part B premium of $202.90 per person. That is the baseline cost. But suppose you decide to perform a large Roth conversion that pushes your total reported income even slightly over that threshold, perhaps to $220,000. Because of that artificial income spike, you have crossed what is known as the IRMAA cliff. The word cliff is deliberate. This is not a gradual increase. There is no partial penalty. The moment your income exceeds that $218,000 limit by even one single dollar, you are subject to the full IRMAA surcharge for the following year. What does that mean in practical terms? Approximately 2 years after your conversion, you will receive a letter from the Social Security Administration informing you that because your reported income exceeded the threshold, you are now required to pay additional surcharges on top of your regular Medicare Part B premium, as well as additional surcharges on your Medicare Part D prescription drug plan. Depending on how large the conversion was and how far your income exceeded the threshold, those surcharges can be substantial. Your standard monthly Medicare premium of approximately $200 could climb to $300, $400, or even $500 per person per month for an entire year. For a married couple, a poorly timed conversion could easily result in thousands of dollars in additional, completely avoidable healthcare costs. This is precisely why retirement decisions cannot be made by looking at one factor alone. A Roth conversion might appear beneficial in isolation, but if it triggers an IRMAA penalty that effectively doubles your Medicare costs for a year or more, the financial advantage evaporates entirely. Every piece of the retirement financial picture is interconnected. This trap directly affects the monthly Social Security benefits you have spent your entire working career earning, and it is rooted in a widespread misconception. There is a common belief that Social Security benefits are completely tax-free once you start receiving them. Unfortunately, that is not accurate. Whether or not your Social Security income is subject to federal income tax depends on a specific calculation the Internal Revenue Service uses called the Provisional Income Test. The calculation works as follows. You take half of your annual Social Security benefit and add it to your other sources of taxable income for the year. This includes wages from part-time work, pension payments, investment income, and, critically, the amount you convert from a traditional IRA to a Roth IRA in that calendar year. The IRS then applies fixed thresholds to determine how much of your benefit is subject to federal tax. For a married couple filing jointly, if your provisional income is below $32,000, your Social Security benefits are entirely tax-free. If your provisional income falls between $32,000 and $44,000, up to 50% of your benefits become taxable. And if your provisional income exceeds $44,000, up to 85% of your Social Security benefits become subject to federal income tax. For single filers, that upper threshold is lower, beginning at just $34,000. Now, consider a real-world example of how a Roth conversion disrupts this calculation. Suppose you and your spouse are living comfortably in retirement, and your provisional income is sitting at approximately $30,000. At that level, every dollar of your Social Security benefit is completely tax-free. Then, after hearing or reading about Roth conversions, you decide to convert $50,000 from your traditional IRA. Remember, the IRS treats that converted amount as ordinary income. Your provisional income immediately jumps from $30,000 to $80,000. By executing that single conversion, you have pushed your provisional income well past the $44,000 upper limit. The result is that up to 85% of your Social Security benefits, income you earned through decades of working and paying into the system, now becomes subject to federal income tax for that year. You may have believed you were making a strategically sound tax decision by moving funds into a Roth account. In reality, you accidentally triggered a completely unnecessary and significant additional tax liability on your monthly Social Security income. Before making any changes to your traditional IRA, the impact on your Social Security tax exposure must be part of the analysis. This reason addresses a very widespread misconception about accessibility of Roth IRA funds, and it has caused real financial hardship for people who did not understand the rules before converting. Many people assume that a Roth IRA functions like a regular bank savings account. Because the taxes have already been paid up front, they believe the money is immediately and freely accessible at any point. The Internal Revenue Service does not operate that way. When you move money from a traditional IRA to a Roth IRA through a conversion, that money becomes subject to a strict regulation known as the IRS 5-year rule. Understanding exactly how this rule works is essential before you commit to a conversion. Every single time you complete a conversion, a brand new 5-year clock begins running on that specific batch of converted funds. This is not one unified clock covering all of the money in your Roth account. If you convert a portion of funds this year, that specific amount has its own 5-year clock. If you convert an additional amount next year, that portion has a separate, independent 5-year clock of its own. Here is the penalty that applies if you access those funds too early. If you are under the age of 59 1/2 and you withdraw converted money from your Roth IRA before those full 60 months have elapsed, the Internal Revenue Service will impose a 10% early withdrawal penalty on the withdrawn amount. But what about people who are already over the age of 59 1/2? A common assumption is that once you reach that age milestone, all Roth IRA withdrawal rules no longer apply, and every dollar is penalty-free and tax-free. That assumption is not fully accurate. Even if you are over 59 1/2, the earnings generated by a specific conversion, meaning all of the compound growth that money produced while inside the Roth account, are not tax-free until that specific 5-year clock has fully expired. To make this concrete, consider how unpredictable retirement can be in practice. Major expenses arrive without warning. A severe weather event may require emergency home repairs. A sudden and serious medical situation may demand large out-of-pocket payments. A spouse may unexpectedly require assisted living or memory care, which often involves significant upfront deposits and ongoing monthly costs. If you have converted a large portion of your accessible savings into a Roth IRA and find yourself needing those funds for an emergency within the 5-year window, you could find your own money effectively locked behind a wall of IRS penalties at the exact moment you need it most. A sound retirement plan always includes an adequate reserve of liquid, accessible cash. You need funds you can reach quickly without requesting permission from the IRS and without paying avoidable penalties. Do not inadvertently convert your emergency safety net into a 5-year restricted account. This final reason requires thinking about your retirement savings not only in terms of what you will spend during your lifetime, but what you intend to leave behind when you are gone. If you have been fortunate enough to accumulate savings beyond what you expect to need during retirement, and your goal is to leave some of those remaining assets to a church, a university, a nonprofit organization, an animal shelter, or any other qualified charitable cause, a traditional IRA is an extraordinarily powerful tool for that purpose. The reason comes down to straightforward tax mathematics. Legitimate charities that qualify under the Internal Revenue Code are tax-exempt organizations. They operate under entirely different tax rules than individuals or even their heirs. If you leave a $100,000 traditional IRA to your children or other individual heirs, the government will require them to pay ordinary income taxes on every dollar they withdraw from that inherited account. Depending on their income and the size of the withdrawal, that tax liability can be substantial. However, if you leave that exact same $100,000 traditional IRA directly to a qualified charity, the organization receives the full $100,000. The charity pays zero federal income tax on that inheritance. Every cent of the money goes directly toward the mission and work of that organization. Now consider what happens if you decide to convert that money into a Roth IRA before making the charitable gift. By converting, you are voluntarily triggering a large and immediate tax bill that you must pay today out of your own accessible cash. You are drawing down your own financial resources right now to prepay a tax liability. And what is the purpose of that prepayment? so that you can eventually leave a tax-free Roth IRA to an organization that was never going to pay taxes on the money in the first place. The charity was already going to receive the full amount without any tax consequence, regardless of whether it arrived as a traditional IRA or a Roth IRA. By converting first, you have simply paid taxes on their behalf, taxes that were never going to be owed by anyone. If charitable giving is part of your legacy plan, keeping those funds inside a traditional IRA is the most efficient and most generous approach available. Allow the account to continue growing. When the time comes, the charity receives the full balance tax-free, and your estate avoids the unnecessary tax payment that a conversion would have required.